going to go ahead and get started here. Good afternoon. I'm Carrie Brubaker. So I'd like to welcome you with a few greetings. So in Turkish, we'd say hoş geldiniz. In Irish, we'd say que de mila falta. And in Spanish, you'd say bienvenido. So welcome to the International Tax presentation today. Myself and Faye Perillo will be running it with, I'm sure, lots of important insights and corrections from our fearless leader, Glenn. So what we're going to do today is we're going to talk about the different forms that are out there related to foreign reporting and when you might need to file them, how you might know you need to file them. So we're going to run through the forms and kind of walk you through that. And of course, please ask questions along the way. The first form we're going to talk about is our 8938, which is the statement for specified foreign financial assets, and also the Form 114, also known as FBAR, and the requirements for each of these forms. While they're both reporting about assets held overseas, the filing thresholds and the reporting requirements are somewhat different. The 1114 is not filed with the IRS. That's filed with the Bureau for the Department of Treasury, the Financial Crimes Enforcement Network, which is a bureau of the Department of the Treasury. Okay, so who has to file this form 8938? So if you are a U.S. citizen, resident alien, and some non-resident aliens, also specified domestic entities, and those that have an interest in a specified foreign financial asset. The thresholds for those filing, and then for the Form 114, that's filed by U.S. citizens, resident aliens, trusts, estates, and domestic entities that have an interest in foreign financial accounts and meet the reporting thresholds. All right, so what gets reported on these? So for the 8938, if you have income, gains, losses, deductions, credits, gross proceeds, or distributions from holding or disposing of assets that would otherwise be reported on your income tax return, those need to be reported. For the 114 form, that's for financial interests in accounts overseas where you're the holder of legal title, the representative, the agent, but also if you have signature authority over accounts. They are required to be filed. Okay, so how do you know if you need to file these forms? Our organizers that we send out to our clients ask that question about if they have any ownership in foreign accounts, any foreign activity. So that's one way to know. Also, just talking with your clients, finding out about their families, you know, where they've lived before. A lot of those kinds of things can help answer those questions for you. Okay, so the thresholds for the filing. So for the 8938, the thresholds for filing for individuals who are living in the U.S. is if your assets at the end of the year are more than $50,000 and your the last day of the tax year they're over $75,000. For married filing jointly, if the total value of the asset was $100,000 on the last day, then you are required to file. for people who are living outside of the US, those thresholds are higher. So for single and married, filing separately individuals, that threshold is 200,000 on the last day of the year or more than 300,000 at any time during the year. And for married filing jointly, living outside of the US, it's 400,000 on the last day of the year or more than 600,000 at any point during the year. And the thresholds are much lower for the Form 114. The aggregate of any financial accounts that are being held, if they are in excess of $10,000 at any time during the calendar year, you add up all those balances and you need to report all of those accounts. Okay, so the value, how do we calculate this fair market value? What are we using? So the fair market value, it is in US dollars and it's converted to US dollars using the exchange rate at the end of the year. And I'm going to share a different screen with you. So where we get our exchange rate from is through the Bureau of Financial Services. If you look on the Bureau of Financial Services and their historic exchange rates, they publish those quarterly, and those will give you the rate. So I just showed here in my example, you're seeing the exchange rates for last December 31st that we would have used on our Form 114s from the prior year. All right.
Hey, Carrie?
Yes.
Go back to that slide.
Absolutely. There you go.
So one thing to point out, because I see this error being made 2 or 3 times a year, is when you're converting currency from the foreign currency to US dollars, you take the amount and divide it by the foreign currency amount. So in other words, where you see Austria, the euro, in order to determine the number of dollars, if you had say 100 euros, in order to figure the number of dollars, you would take the 100 euros divided by 0.89, not times 0.89.
All right, thank you, Glenn. That's a good point to remember. All right, so when are these forms due? Where do they go? So the 8938 form goes with your individual tax returns. So those are due, including extensions, whenever your return is due. The Form 114, you have an automatic extension, so it's due April 15th. Again, not going to the IRS, but it can have an automatic extension to October 15th. And Glenn, maybe you can just clarify for me here. There was some talk that for 2020, they were going to extend it to December 31st, but then I think that was a mistake that got published. Is that correct? Still October 15th?
I think so, but I'm not 100% sure about that. Oh, and but while I'm talking, the FBAR has to be filed electronically, period.
Yes.
There's no paper way to file it.
Correct. And for as with individual returns, we have the 8879 that gives authorization for us to file on behalf of the client. The Form 114A is that same type of authorization, right, Glenn?
Right.
Okay. Yes. So there is no option to paper file that. All right. The big theme today is the penalties for not reporting foreign activity are steep. They are no joke, and we got to be really careful and make sure we're asking good questions and being aware of these issues. So for the 8938, it's up to $10,000 for failure to disclose. And if you receive a notice and you continue to fail to disclose, the penalties can go up to a maximum of $60,000. For the Form 114, the penalty for a non-willful exclusion is $10,000. If it's willful or the asset is greater than $100,000, the penalty can be as high as 50% of the balance of the account. So those are no joke. We got to really stay on top of that. Oops, sorry. All right, so next up, I've got information about this form 5471. So what the heck is that? It's used for U.S. persons who are officers, directors, or shareholders in certain foreign companies. And there are categories of filers. There it goes. So there are 5 different categories of filers that are required to provide different types of information on the Form 5471. So again, it depends on ownership interests and who had control of the foreign corporation. So I wanted to show you an example of, so this is the how would you know you need to file this. So one of our clients received this type of a footnote for an organization that they are involved in, and they do go on to tell them which filer they are and what information they have to provide. So they also provided us with the form filled out to know that this is a Category 2 filer, and provided the types of information that need to be disclosed on behalf of this client. All right. Okay, so again, penalties here, very steep. $10,000 penalty, can go all the way up to $50,000 for not filing that form. And so even though there's no tax changes, this doesn't impact the tax balance due. You still can come up with these kind of penalties. So want to be careful on those. All right, so next up, 5472. And this is a form to disclose information for a 25% foreign-owned U.S. corporation or foreign corporation engaged in U.S. trade or business. Sorry. Okay. Who must file? So we have U.S. corporations with 25% or more foreign shareholders. You report all intercompany transactions between U.S. reporting companies and related foreign persons. And a separate form is filed for each 25% foreign shareholder. The penalties for this form are the same as the 5471. Moving on. All right, so next up we have the 8858. And that form is used by U.S. persons that operate a foreign branch or a foreign disregarded entity directly or indirectly. So this is a form that we use to report overseas rental properties. So if we know that a client does have an overseas rental property, we need to look at filing this 8858. Okay, so there's a little bit about who must file the form. Again, the penalties here can be anywhere between $10,000 and $50,000 for not reporting. So, as always, don't forget to report. Then we've got Form 8865, which is the return of U.S. persons with respect to certain foreign partnerships. This form is used to provide information about controlled foreign partnerships, transfers to foreign partnerships, acquisitions, dispositions, changes. It also, if it's applicable, it needs to provide information for its calculation of the foreign derived tangible income deduction. Much like the 5471, there are different categories of filers, depending on what type of category then dictates what information on the form you fill out. Again, penalty is about the same as the other forms there, 10,000 up to 50,000. And our first word for the day is gracias. So we'll leave that up for a second. Make sure you got the spelling correct. First word up is gracias. And now I'm going to turn it over to Faye, who is going to continue on.
All right. Hi, everyone. Let me see if you guys can see me. I'm going to ask Carrie to unshare her screen.
Okay, I think I did.
All right. So my name is Faye, and I am going to share with you a little bit more about the other forms that are more common. Hi, somebody said hi. But before we do that, I'd like to remind everyone that please feel free to ask questions, interrupt us, or you can raise your hand if you want to do it politely. You can unmute yourselves, and that's fine with us too. Or if you think of something later on as we go through the forms, and then you might think, hey, this is relevant to my client or my business, then please reach out to any one of us in the tax department, particularly the international tax team, and I'm going to give you their names, our names later on, and we'll be happy to try to figure these things out for you and learn these things with you as well. So we are available. We're here for you guys. Before I move back to the PowerPoint, I would like to share the second document that we actually have in our launch site, and it is called Summary Chart. I believe that's what it's called. Let me see if I can share that with you. All right. Do you guys see that? Yes? Okay. So what we have here is just a little summary of the forms that we put together, the more common forms that we see with regards to foreign assets, foreign income, as it relates to U.S. tax filing requirements. Now, there are other forms that were not included in this summary, and I am going to discuss those with you in more detail. Some of them are in the slides as well, but I want to go over the newer ones. There are some changes that are pretty recent and the ones that were not included. So please feel free to use this form. You can download and print as you wish. Any questions so far? All right. So now I'm going to move on to my PowerPoint. Can you guys see my PowerPoint? No? Yes? All right. This is good. So I wanted to talk to you guys about the streamlined filing compliance procedures. I'm going to keep asking, can you see this? Can you see that? I can't really hear. I get no reaction because it's not a live audience, so I'm talking by myself here. But I wanted to talk to you about this set of procedures that are available to our clients, to prospects, or even to your business, and see if this could be helpful. If this, David said we're alive. Oh, that's good. And see if this can be useful. Carrie mentioned earlier that when it comes to foreign reporting, penalties are steep, like at least $10,000. And I have had some people said, oh, my CPA didn't tell me anything about that. And then they panic because they don't have an extra stash of 10,000 somewhere. Or it could go higher than 10,000. But you know, people make mistakes, and when we say mistakes, they're probably unintentional. So it's not the end of the world, I don't think. There is a way. There is a way where, let's say that they did not make those filings as required, but they really did not mean to do it. So these procedures are available. We have two types of these procedures, and I highlighted and underlined them so you'll see the difference real quick. So one, they're both offshore procedures. One is foreign and one is domestic. So what does that mean? So one is available for U.S. Taxpayers, or U.S. persons, I should say persons, who are living outside the U.S. And then you have a different set of procedures for those who lived inside the U.S. So, all right, a little bit confusing. But the good news is, if you read the bottom portion of the slide, it says, if you go through this, it will not be subject to failure to file and failure to pay penalties, accuracy related penalties, information return penalties, or FBAR penalties. So there is a way out. So we get excited when we find, there is a way out. So let's go to the next slide. Like I said earlier, this is available for U.S. individual taxpayers, including estates and individual taxpayers who may have failed to report income from your foreign financial assets that Carrie mentioned earlier. And if these assets generated some sort of income, they may not have, but if they did and you failed to report the income part of that, and also the second bullet point, you may have failed to also file your FBAR. And so this is an and these failures resulted from a non-willful conduct, meaning to say you did not intend to do it. So you have to actually later on, and I can show you, you have to actually kind of prove to them that it was not intentional. You have to file a certification that describes your situation. And sometimes it can be a little bit personal, but there is a form that you have to fill out that will kind of explain to the IRS why you're telling them that it was non-willful. Any questions so far? Trying to see here. All right, so let's move on. So the first one I'm going to talk about is the foreign offshore procedures. This is for U.S. taxpayers residing outside the United States. I'm going to give you a quick example so you can kind of imagine the situation here. So we had a client, a lady who is a U.S. citizen, but at maybe 20 years old, she moved to, I can't remember, Belgium or Germany. So she lived there right after, I think, college. She lived there, got married there. So she lived either in Belgium or Germany. I can't remember now. And then while she was there, she totally did not know. She thought that once she moved out, she didn't have any more filing requirements in the US. But you probably know that for US tax purposes, the US will tax you for your worldwide income. So you gotta be careful with that. So she thought she had no idea. She thought that she was good. She lived her life. She had kids and grandkids maybe. And then when she came back to the US, she was probably already in her 70s. And then she found out that she still had to file US tax returns all those years. So she came to us and she asked us for help. So this is the example where she was outside the country, but she needed to be caught up, to get caught up with her filings. And if you added 10,000 for each year, that would have been too much. So thankfully, we have this provision, and we kind of studied if this was applicable to her, and it was. So what we did was, just to make the long story short, what we did was we, and her assets are all in either Belgium or Germany, mostly pension funds, but they were earning minimal amount of income. But we had to, so she never filed tax returns. So we had to do, the rule is, and you can read this later on in your material, but she had to submit 3 years worth of the most recent 3 years delinquent tax returns. And she had to submit electronically, like Glenn said, 6 years worth of FBARs. And then the certification that I was telling you about, which is the form 14653, telling the government about her situation. You know, it's a sworn statement that I failed to do all these things, but these were all unintentional. And I could show you, hopefully I can show you what that form looks like. So it's just really another IRS form. So these are, can you guys see that? Yes, can you guys see that? All right. So this form shows the last 3 years, and that she had not filed. Oh, you can't see it, Glenn? Helene can see it.
Oh, yeah, I can see it. I was responding to David's answer to my question.
Oh. A little trivia. Well, I didn't know that. So Glenn's question, and we're going to go back to our topic, but this is fun. Can anyone name the only other country in the world that taxes its citizens on their worldwide income regardless of residency? Aside from the US, right?
Yeah, aside from the US. Nope.
The person who can answer it correctly, I'm gonna give you 5 pesos, Philippine pesos.
Is Luxon on here?
He's not here, but
No.
I can't remember. He's from, where is he from? I can't remember. His plate says it. No, his plate. There, Zimmy.
No.
Zimbabwe.
No.
No. All right, Glenn,
Okay.
just spill it.
Don't need to waste any more time. Eritrea.
What?
Eritrea.
Is that a country?
Yeah, it's in Africa.
Oh, sorry.
I think that's where Luxon's from.
I thought he was from Zimbabwe.
Oh, well, maybe I'm wrong.
All right, that was fun. So going back to the form, I wanted to show you that, you know, you make all these statements to the IRS saying, I failed to report, I'm eligible, I failed to file my FBAR, but then at the bottom here, right here, at the bottom, you actually have to provide a reason why that happened. And so in that case of that lady that we helped, we actually had to explain to them that she moved to a foreign country and she really did not know. I don't think she worked when she was there except for maybe some part-time work, Glenn. So we had to explain that to the IRS and submitted this form together with all the other filings that I mentioned a while ago. And so she did not have to pay anything. And for those delinquent taxes, delinquent tax returns, she did not owe any US taxes anyway. So that was also good for her because she actually had to write those years down, how much amounts that she owed in her delinquent 1040s and any interest, if she had any. But for her case, she did not have any taxes due on those 3 years. So that was really good. And I thought that was helpful. All right, so I'm going to move on to the other one, the other procedure available for people who might have missed this filings, your foreign filings, including your FBARs, is called the Streamlined Domestic Foreign Offshore Procedure. So this is now for U.S. persons who live in the U.S. They're not outside of the country. And so that you understand better, I'm going to give you another example of a person we helped through this procedure. So this time, he was not a US citizen. He was a UK citizen. So he was a UK citizen, but he moved to the US. So he lived in the US. However, and he filed his US taxes. However, he did not include some funds that he had. I think that they were some pension funds when he still lived in the UK that he left in the UK banks. So he had those funds in there, and he had some, I can't remember, money market probably over there in the UK. He only reported his assets here in the US, and he failed to report those assets that he left in the UK. So he lived here, he still lived here. Then he found out about this. So he did not have any 89, 38 on his 1040. So he excluded that part. In other words, his 1040 was wrong because it excluded the 8938, and he also did not file FBARs. So this is the other side of it, where he lived in the US but filed incorrect tax return. So a little bit different from the first example. For this guy, what we had to do, he wasn't delinquent. He had filed 1040s. However, what we had to do for the past most recent 3 years, we had to amend his 1040s to rightfully include the 8938. We had to file the 6 years worth of FBARs. And we had to also attach a certification as well. This is similar to the other one I mentioned. However, I don't know why, but I think they did this intentionally. For this case, for the domestic offshore procedures, if you live in the US, there is a miscellaneous penalty. It's not as big as what it would have been if he had to pay all those penalties that Carrie mentioned earlier. But it's a 5% offshore penalty. There is a calculation. So it says here it's 5% of the highest aggregate balance of his financial assets that are subject to the miscellaneous penalty during the years that are covered in that 6 years FBAR period. So I think what we did, we had a little spreadsheet where we had to calculate it. It would have been the highest balance for each one. I think I gotta remember the highest aggregate balance, and then we added them all up, and then we had to use that number to multiply by 5%, and that's how we got the penalty, the 5% penalty. I think that's how it goes. And then, so we put that packet together, the 3 amended returns and the 6 FBARs and the certification and the calculation and then the payment. We had to send that over, and the IRS accepted it. So that's how that was helpful to that taxpayer. Do you have any questions so far? I think there might have been, Joan might have had a question and Glenn answered it. Any other questions related to this offshore procedures that are available? I think this is pretty good thing to know, just to have in the back of your mind if you ever get into that situation where a client or your own people that you know, forgot about these things or really didn't know about these things. So let's talk about it and let's see if this is an option that could be helpful.
Hey, Faye.
Hey.
So another thing to keep in mind while you're dealing with this is if you're dealing with, say, a U.S. citizen that's living in a foreign country, one thing you always need to read. First of all, you always need to check and see if the U.S. has an income tax treaty with that foreign country,
Okay.
and if so, you need
Yes.
to read that treaty because most of our U.S. treaties have what's called a saving clause, which says that notwithstanding whatever's in this treaty, the U.S. can still tax its citizens on their worldwide income. But some of them have exceptions, except for pension income or except for certain types of income. So you could have a situation where you have a U.S. citizen who's getting income from a state pension in the Netherlands or something like that, and while that's part of their worldwide income, it might not be taxable in the U.S. And also, even though U.S. citizens and residents are taxed on their worldwide income, to the extent that they're taxed on foreign source income, they can claim a credit, and to the extent of the foreign tax that they pay. And there's also situations where income can be resourced, depending upon circumstances, to where what would otherwise be U.S. source income can be, if it's taxed in a foreign country, and under the treaty it's taxable to a foreign country, can be treated as sourced in that foreign country, and therefore you can get credit for the foreign country's tax paid on your U.S. return. Sorry, that's kind of confusing.
So it can get confusing. It really varies depending on the country. So thankfully, I'm going to show you later the tools that we have available if you want us to research on certain countries, and we'll be happy to help you. There is a question. I don't know the answer to this, so I'm going to throw it out there. Maybe Glenn can help us out. Ian Walsh is asking, are we covering the repatriation tax, and was that specifically to avoid this tax?
Was what specifically to avoid this tax?
Repatriation tax.
Repatriation of income.
Repatriation tax.
The flat rate.
Oh, no, that's separate. You're talking about the 965?
Yes.
Tax? No, we haven't got into that. The repatriation, the 965 tax was put in place within the 2017 Tax Act, and it was basically the idea is to put the U.S. on a more of a territorial tax regime, and basically taxed companies on income on their accumulated earnings from offshore that had not been taxed in the U.S. before because it was in offshore subsidiaries or whatever. And I don't know that you're going to cover that. And actually, the 965 tax it's a one-time thing. It can spread out over, I think it's 8 years, but it was a one-time thing to put the U.S. on a territorial basis.
All right. So
Thank you.
I'm going to move on to the next form, which is pretty new as well, which is, and this is just recent, 2017, included in the TCJA, where U.S. shareholders of controlled foreign corporations are now required to include in their income GILTI. It's called GILTI. It's Global Intangible Low Taxed Income. And the form that you use for that is the form 8992. So what is a CFC? It is a foreign corporation, so it's called a controlled foreign corporation, of which more than 50% of the total combined voting power or value is owned directly, indirectly, or constructively by U.S. shareholders. So if you are involved, you're at 10%, actually, that's in the next slide. A 10% shareholder of a controlled foreign company, so you're involved in that kind of activity, then you may have additional income that needs to be included in your income. So I'm just going to read this out. The purpose of this is to reduce the incentive for US-based multinational corporations to shift their profits out of the US into other countries that may have lower, if you have high tax here and you get it out of the US, that may have lower or zero tax jurisdictions. So people could think of that as a strategy. Well, now the IRS has this strategy of including your share in that CFC, in that corporation, as part of your income. So that's going to be filed under Form 8992. Anything else we need to add for that form, Glenn? I haven't seen many.
Yeah, so again, like Faye said, the reason for this was because as I'm sure everybody's read or heard about, major companies, U.S. multinationals, would shift income outside the U.S. by moving intangible assets to other countries, particularly countries with lower tax rates. Mm-hmm. And so, the company might move its intangibles, trade name, intellectual property, what have you, to say Ireland. And so they would pay royalties to that company in Ireland, as a means of shifting income from the U.S. to Ireland, which has a much lower tax rate. So the GILTI tax was put in place to tax, just like it says, intangible low taxed income.
A related form to the GILTI, thank you, Glenn. As I'm looking at our time, a related form to that, look, they're going to tell you need to include this income, but there's also an available deduction for it, which I thought was kind of interesting. So there is a deduction for that amount that you include in your income, which
no, it's two different things. So, for example, if I've got if I'm a U.S. company that's a U.S. company is going to be subject to, just like a U.S. individual is going to be subject to tax on its worldwide income.
Oh, they take. So
if I'm a U.S. company that's selling goods offshore, I'm still taxable in the U.S. on those sales, but I can get a deduction as part of this that under Section 250 for my foreign derived intangible income. So and that's a calculation where you take your to the extent that your sales, your offshore sales, I lost my train of thought. So your profit from your offshore sales exceeded what would be a 10% return on your hard assets. You're treated essentially as if you took back, intangible income from offshore and you're paying tax on it, so you get a deduction. GILTI is where you're recognizing intangible income offshore in a subsidiary or whatever, and you're having to pay tax. You're being taxed in the U.S. on that income that otherwise would not be taxable in the U.S. Does that make sense?
Somewhat. So I failed to include this in the slide, but so generally this is the GILTI rate, and then if you apply the deduction, then it ends up with lowering your effective rate for GILTI to 10.5. And then I guess we're out of time. Carrie, I'm gonna give this to Carrie. Do you have other things? I know there are a lot more forms that we have in here, but
yeah,
we touched mostly on the more common forms and the new ones that we thought you all should know. And the rest, if you could just read through them, and if you have questions, again, we're happy to help you guys.
Hey, I think you skipped over your code word.
Oh, we got to give them the code word. I'm going to give them right now. I don't want you to not have your CPE. So I'm going to go give you 2 code words. Did I skip it? Sorry, guys. So the second code word is salamat, which is, please write that down. Thank you for, in Filipino, which is where I'm from, the Philippines.
And then Faye, do you want to briefly just let them know about our tax research?
Yes. So I hope you can see my screen. So earlier I said that we do have the complete international module under Bloomberg Tax, where we can research like a treaty for a certain country with the US. We can build charts, like a withholding tax charts for different countries and the different income, a treaty comparison tool, and country guides, like what's being taxed in that country, how do they tax it. So we do have those resources. And like I said earlier, also, we're building a international tax team, if you can see my slide. So we have our leader, our fearless leader, like Carrie said, Glenn, and Carrie, myself, and Josh Rifle. So please come see us. All right. Should we go ahead and give them the last code word, or do you have anything else? Oh.
So yes, why don't you get that last code word ready? And our real takeaways from today are, there's a lot of information out there on foreign reporting. There's a lot of requirements. When in doubt, ask Glenn. The penalties are steep, so be careful. And we have, we have the resources here at the firm to help answer those questions, really look at those K1s, that type of thing. All right, our last code word. Merci. So thank you all for coming today.